Um, but yeah, if they leave an opportunity to buy dirt cheap one DTEs, um, I'll pick some up without a doubt. I'm gonna spend some money on that. Like sometimes they've run it Wednesday morning, but they've also run it around noon if they place the orders in a dark pool. And so if they do that, if it's going to run midday, that means options are going to be super cheap for the week. 2K likes and we trigger MOASS. I don't think that's how that works. So Friday before leap expiry is 12/17, I think, right? Yes. Before the first leap expiry. That's the first set of ETF leaps and equity leaps. So yeah, and the T+2 for that is December 22nd. What price point for 12/17 looks good? I mean, nothing. I mean, you can go far out of the money, but you'd have to, sell them if we run next week. Um, I guess that would depend on what price we're trading at. If I consider it, it's still more likely. I'd rather buy January's. Do you get Pickles picks at Long Johnson or Dillionaires? It's in Dillionaires. Um, what widget is that shows your order positions and WeBull like you have over your shoulder? I think it's just called positions. We got another IV spike coming today or nah? I don't know. But we failed the EMA 60. So I got out of the rest of that. There's just like this just ended up being like kind of a nice day trade. How risky is it to hold at the money options until its expiration date? It'll lose a lot of value. It needs to be in the money for theta decay to slow. Using the actual desktop app or just browser? I don't use the browser one. I just use the desktop app. Exercise options, which is what I understand to do with them, ask for your shares, essentially. Not ask, demand. There is no ask. It's not a kind thing. A written naked call must be satisfied, or a buy-in is forced. It is in effect a margin call. And the beauty of it is you can't satisfy it elsewhere. You can't satisfy with synthetic long because otherwise you triple leverage your losses as a call writer. So if Citadel attempted to satisfy the exercising of a call with synthetic longs, they would lose triple the. Not only would they lose the amount of the call, and they would also lose the difference between the share at the time of exercise and the share at the arbitrage between the time the call is exercised and the shares are delivered, which could be significant if the price is running. On top of that, they also have to margin off the synthetic shares they're using to satisfy. So it creates 3 times the pressure if they attempt to satisfy with synthetics. And since there's no shares available, right? Retail owns the float, then they need to either satisfy with synthetic longs, which, you know, as we just discussed, create uh, pressure in triplicate, um, or they have to buy shares at market. And since we own the shares, and no one's selling, that drives the price up. So hold, exercise, moon. Thoughts between April 510, June 680. For an extra 200, you get an extra cycle to time MOASS. Seems worth it, but I'm options newbie. Anything I'm not considering here? Just don't be like that guy who's like, I bought leaps and they were, 10x 3 times and I never sold them. This weekend, Stoic Prince. So when DFE held his in the money positions until 416, he wasn't losing much value. He was not. Yeah, I'll clip that.